been made in the computation of income to that effect. So that's why reporting in clause 10b is very, very crucial. This is the question we dealt with for newly started business. Similarly, if a business has closed down, whether the expenditure incurred after closure of business is allowable. By and large, no. Expenses incurred after the closure of business cannot be considered as expenditure for the business because the business does not exist. It's already been closed down. So expenses incurred after closure of business are not allowed as a deduction. So the moment you report this in clause 10b, that the SSE has closed down a particular business from so and so date, the logical question is, expenses after the closure, have they been offered for disallowance? There's only one exception here. Courts have held that even after closure of business, whatever minimum expenses that the SSE needs to incur to keep the existence of his profit-making apparatus alive, let's say audit fees, tax audit fees, etc., those expenses can still be claimed as a deduction. So the reporting in clause 10 is very closely aligned to from what date the expenses become allowable and from what date the expenses get disallowed. Now let's look at some controversies. Whoever of us have handled individual returns this year and last year, especially in COVID times, 8 out of 10 guys are dealing in shares. And everybody claims to be an investor and everybody claims to be a long-term investor. The reason they're a long-term investor is because their portfolio is in losses. But anyways, that's a different topic altogether. Now, if somebody is dealing in shares, whether that dealing in shares becomes a business, and if it becomes a business, it requires reporting in clause 10. CBDT issued a circular in 2007, Circular 4 of 2007, explaining in what cases dealing in shares can be considered as business. The circular only gives guidance. It says you look at frequency, you look at volume, how frequent is the buying, selling, where is the SSE getting the money from, is it trading on margins, is he borrowing and investing, etc., etc. So the moment you see any transactions or any dealings in shares and securities, first and foremost, we have to ask ourselves a question whether this is business or whether it is an investment. If it is business, it qualifies for a reporting in clause 10. Similarly, if somebody is dealing in F&O, whether it is speculative business or a non-speculative business, based on that, we have to take a call of reporting in clause 10. Here, one important concept is adventure in the nature of trade. If you look at the definition of business in section 2, business includes adventure in the nature of trade. What does it mean? It simply means that if an SSE is doing an activity which has traces of business, but it is an isolated transaction done in a business-like manner. Such isolated transactions done in a business-like manner could very well qualify adventure in the nature of trade. And it becomes business, requires reporting under clause 10. So we have to be very careful. If we are not reporting the share transactions on clause 10, we are essentially, knowingly or unknowingly, taking a position. The share transactions of the SSE are investment transactions, they are not business transactions. So we should be very careful that whether the facts justify that the share transactions are indeed investments, they are not business transactions. Examples could be, we have seen cases where SSE's income is 10 lakh rupees and the volume of dealing in shares is 5 crore rupees. Now, nobody who has an income of 10 lakhs makes an investment of 5 crores. Definitely, 5 crores does not mean that he's put in 5 crores and he's taken out 5 crores. It basically means he's buying, selling, adding up to 5 crores. And given his income level, if the volume has reached up to 5 crores, it indicates that there are multiple transactions of buying, selling that is happening. There are good indicators that this activity could qualify as activity of business, not that of an investment. So it's a conscious position we have to take in this case. One question I have on the chat box, what is adventure in the nature of trade, if I can explain? So adventure in the nature of trade is basically an activity which is not an investment activity. Let's say you have a plot of land of 1 acre. Okay, you are creating smaller plots of that plot of land and trying to sell the plot one after the other to maximize your profit. Now, this is a transaction which is on the borderline because you are not otherwise in the business of dealing in real estate. But you're selling the plots like a businessman to maximize your profits. Such transactions could be considered as adventure in the nature of trade. Similarly, there are questions on F&O loss audit to be done. Okay, I presume it would have been covered yesterday in the presumptive tax section, but today, very quickly, I'll say for futures and options, how do you calculate turnover? Institute has given a guidance. For F&O transactions, you take absolute values of profits and loss, you add them up, and that becomes turnover. Example, let's say trade 1, there is a profit of 100. Trade 2, there is a loss of 30. Now you remove the minus sign from 30, you add 100 plus 30, 130, that becomes the turnover for F&O business. Okay, clause 11, books of accounts. Very simplistic, you only have to say whether books are maintained, if books are prescribed, how are they maintained, where are they maintained, etc. Clause 11C is what is important because what you have to specify here is list of books of account and nature of relevant documents examined. So if the SSE has undertaken a transaction where the agreement becomes an important aspect. Now, agreement is not books of account, but you would have looked at that agreement when you are completing the tax audit. That is a relevant document for tax audit that needs to be specified. So whichever document which in your professional judgment is relevant from an audit perspective, that document needs to be specified. Method of accounting, clause 13. So it says which method of accounting you are using, cash or mercantile. If there is a change in method of accounting, you have to disclose the fact that yes, there is a change in method of accounting. And if there is a change, what is the impact of such change on the profit or loss for the year? The reason is obvious why this information is being asked. First, department wants to know whether you have changed the method of accounting and whether that change is a legitimate change. Have you done the change only to take care of the profit, or are there reasonable grounds for you to change the method of accounting? Another aspect connected to this is once the department collects these data points, department can check whether the change of account method is only a one-off case or the SSE has a history of changing method of accounting time and again. Because if the SSE is changing the method of accounting again and again, it has traces of artificiality which may be looked into at the time of the tax closure. Next. Can the SSE adopt different methods of accounting for different businesses? Answer, yes. The method of accounting is business specific. You can very well have different methods of accounting for different businesses, provided the SSE has adequate accounting system to ensure that the transactions are properly recorded. Conceptually, it is possible to have different method of accounting for different businesses. Clause 13D to E deal with ICDS. ICDS stand for Income Computation and Disclosure Standards. What is ICDS? Okay, before we get there, ICDS always reminds me of an instance when I was back in school, or we can also all reflect on our school days. Homework is a very common thing in everybody's school life. There are 3 types of kids in any classroom when a homework is given. There is one section of kids, if the homework is given, they will do the homework diligently and they will submit it to the teacher on time. There is another class of students, no matter what the teacher does, they'll not do the homework. And a lot of students, me included, are in the in-between category, who want to do the homework, but they are not diligent enough. So, they will wait till the last day and then they'll burn the midnight oil somehow to complete the homework. Now, what such students do is they will borrow a book from the more sincere student who's already done the homework and copy his homework into his notebook. But these kids are smart. They know that if I copy exactly what the sincere student has done, the teacher will catch me. So what they do is, they pick up the homework of the sincere student, they add a few lines, they reduce a few lines, they change a few words so that the homework appears as if it is their own homework, it is not copied. Unfortunately, one such student went and sat in the CBDT and he wrote something called as income computation and disclosure standards. He picked up the accounting standards given by the institute, added a few lines to it, subtracted a few lines to it, and came up with something called as income computation disclosure standards. The concept of ICDS is this. CBDT says that accounting gives you a lot of alternatives. So different people can account for the same thing differently. It is unfair. So we want a uniformed method of how accounting should happen for tax purposes. That's why we are giving you these income computation disclosure standards. Whatever you may be doing in the books of accounts, for income tax purposes, do the accounting in a particular manner as we tell you. So as on date, we have 3 ICDS that are notified and 10 ICDS that are notified. 3 are in the draft stage. I think department has also lost interest in those draft ICDS. Highly improbable that they will be announced. ICDS apply to SSCs following mercantile system of accounting. So if your SSC is following a cash method of accounting, ICDS do not apply. ICDS apply for income under the head PGBP, that is business income, and income from other sources. Then ICDS go ahead and clarify that ICDS will not affect the books of account. So you do your accounting the way you want. For income tax purposes, you calculate things differently. And if there is a conflict between ICDS and the act shall prevail. Where does this leave us? So what we've seen thus far, there is something called as ICDS. They deal with accounting, but for tax purposes. So how do we deal with this situation? The approach is straightforward. Look at the relevant accounting standard, look at the ICDS, and see what differences are. If accounting standard and ICDS is same, life is simple, no adjustment required. If accounting standard and ICDS are different, follow the ICDS, make adjustments in your computation of it. Similarly, compare the ICDS and the Income Tax Act. If there are similarities, no question. If there are differences, then think whether you want to go by the ICDS or you want to go by the Income Tax Act. As a tax auditor, we have to report that whether any adjustments are required under ICDS, whether there should be an increase in profit or there should be a reduction in profit. Clause 14, inventory. 2 questions are asked. What is the method of accounting for valuation of closing stock? And there is a guidance under section 145A of how to do inventory valuation if there is a deviation there. If you look at 145A, it looks complicated. It is also. But if you look at it really speaking, at the core of it, what does 145A intend to achieve? For those of us who have actively worked in GST, we know that there is a concept of input tax credit. So if I have purchased something for 100 rupees and 18 rupees is the tax levied on it, I will debit my P&L for 100 rupees. And the 18 rupees GST, which I am claiming as a tax credit, I will treat it like an asset. And then I will offset it against my GST liability. So 100 rupees goes to P&L, 18 rupees goes to balance sheet. This is called exclusive method of accounting. That is, the taxes are excluded in debiting the P&L. Similarly, if you sell something for 200 rupees, you credit the P&L with 200, you create a GST liability for 18% of 200, that is 36 rupees, the GST liability sits in the balance sheet. Same thing, exclusive method of account. Now, income tax says that you have a choice. Whether indirect taxes, everything you want to pass through the P&L or you want to keep them in the balance sheet. But justify to us that whether you follow inclusive method or exclusive method, there is no impact on profit. Section 145A talks about inclusive method, where they say all taxes you should pass through P&L. But SSE has an option of taking the taxes to the balance sheet to follow exclusive method. So if the accounting is proper, the difference between inclusive and exclusive method will be zero. But that is what needs to be justified. That's the concept. Practically, it becomes little cumbersome because then you'll have to identify each and every line item of income, expense, sale, inventory, and do the working. But at a level of simplicity, this is what it says conceptually. Clause 15. Conversion of capital asset into stock in trade. A bit of background of the legal provisions. When you convert a capital asset into stock in trade, it is treated as a transfer for capital gains purpose. Now, in ordinary situations, the moment there is a transfer of a capital asset, you are liable to capital gains tax. But for conversion of capital asset into stock in trade, there is an exemption given that you will have to pay the tax when you ultimately sell the stock. Okay, so the tax is determined at the time of conversion, but paid at the time of ultimate sale. Now, as a tax auditor, the responsibility is cast on us that the moment there is a transaction of conversion of capital asset into stock in trade, we have to report it on the tax audit report. This is basically an anti-abuse mechanism that no SEC can, in future take a stand that, oh, I converted the capital asset into stock in trade 3 years ago. So that's the anti-abuse provision. The moment the conversion happens, it gets reported in the tax audit report. So the fact gets crystallized that yes, capital asset is converted into stock in trade. Clause 16. Items of income. What this clause basically says is something which should have come to P&L. But because of some innovative accounting, it has not come to P&L. You have parked it onto the balance sheet. Now, because it has not come to P&L, chances are that that particular income will escape taxation. Back in the 1990s, some companies were taking that position that if I have a piece of land which I have, say, bought at 100 rupees, and 20 years later, I have sold that land at 500 rupees. In normal course, the profit is 400 rupees. Accounting standards today tell us that 400 rupees should be credited to P&L as profit on sale of asset. But back then, companies could park this amount as capital reserve in the balance sheet. So anybody looking at the P&L will never come to know that the land has been sold. The entire profit is treated as a part of reserves. Now, such transactions ideally should get reported under clause 16. A common misconception is, let's say the SSE has savings bank interest. Should I report it under clause 16D, any other item of income? Because savings bank interest is definitely income. That income has to suffer taxation. So why should I not report it under clause 16D? Because that's what the clause says. This is where we go back to the original discussion that the tax audit is an audit of business. It is not the audit of an SSE. So the savings bank interest has got nothing to do with the business of the SSE. It's a personal transaction. It should not get reported on clause 16D. That's where we also discussed at the start of the session that tax audit report is not comprehensive. There could be other items of income which the SSE has to otherwise deal in his tax return, which are not captured in the tax audit. What gets reported in clause 16 is items of income which are business income but are not credited to P&L. Only those items will get reported here. I'll give an example to tell you what could possibly get reported under clause 16. Okay. Let's say the SSE is a doctor and he does a very complicated surgery. The patient is very happy. He tells the doctor, this is a Mercedes car which I'm giving you out of love and affection. Sir, please take my car. The doctor brings the car is at his home. Now, no money has exchanged hands. Nothing has come into the bank account. So chances are nothing will get credited to P&L because there's nothing coming into the books of it. But there is a provision under section 28 clause 4, which basically says any non-monetary benefit arising from business or profession needs to be offered to tax as business income. Now, when you are doing the tax audit and a transaction like this comes to your attention, this is what you will report under clause 16A, items falling within the scope of section 28, not credited to the P&L. There is only one exception here. If you look at clause 16E, capital receipt, if any. Now, by its very nature, capital receipts are not charged to tax. But department wants to examine that what you are claiming as a capital receipt, is it really a capital receipt or you are doing it for tax avoidance purposes? So only clause 16E possibly could have reporting where the SSE has a capital receipt, which otherwise is not taxable. Still, from a disclosure perspective, it should get reported under clause 16. Clause 17. Clause 17 deals with a case where land or building is transferred and the transfer is below stamp duty value. There are two provisions applicable here, 43CA and 50C. 43CA deals with business income, 50C deals with capital gains. So what clause 17 says, if the SSE has transferred land and building at a price which is below the stamp value, please make a disclosure, give particulars of the property, what is the consideration actually received, and what is the stamp duty valuation. There is a 10% tolerance limit introduced from financial year 2021, which basically says that if the difference between the transaction price and the stamp valuation is not more than 10%, then the transaction does not attract 43CA or 50C. There's another limit of 20% on first sale by a builder or developer to the home buyer. Two questions we should look at here. 43CA and 50C both basically say that the SSE has an option of challenging the stamp valuation. Let's take an example. Let's say the property, the stamp valuation is 100 rupees and the transaction price is 70 rupees. So the difference of 30 today gets taxed in the hands of the SSE. He's got 70, but he pays tax as if he's got 100. This is because the stamp valuation is 100. The SSE has an option of challenging the stamp valuation. Now, in this case, where the transaction price is 70, stamp valuation is 100, and the SSE has challenged the stamp valuation, what should we do as a tax auditor? Should we report it? Should we not report it? In that question, we go back to the clause. What does the clause say? Whether the land and building or both is transferred during the previous year at a value below stamp duty value. The question nowhere asked whether it is taxable under 43CA or taxable under 50C. It simply asked you a factual question whether the transfer is below the stamp valuation. So whether or not the SSE has challenged the stamp valuation, we have a reporting obligation. We should report the transaction. Yes, you may supplement it by way of a note to the tax audit report saying that we are reporting the facts. The SSE has challenged the stamp valuation and leave it at that. But reporting obligation certainly remains. Important aspect, reporting under clause 17 is required only if the transaction price is below the stamp valuation. Let me put it in terms of an example. Say stamp valuation is 100 and sale price is 150. So the Anti-abuse provision of 43CA or 50C does not apply because the actual transaction price is above the stamp valuation. No reporting required under clause 70. Next aspect. Consideration is less than stamp value, but it is within the 10% tolerance limit. So 43CA or 50C conceptually does not apply. Do we report? Again, we go back to the clause. Clause says whether the transfer is below stamp value. Clause has nowhere said that whether it is within the tolerance limit, or it has not asked you anything about taxability. It's a factual question. If the stamp valuation is higher than the transaction price for whatever reason, disclosure has to be made. Now, I'm seeing certain questions in the chat box, which are very legitimate questions, saying that if we go on reporting or making a disclosure like this, CPC is picking up certain things and asking questions to clients or proposing additions. In certain cases, they're actually issuing 143(1) with additions. Yes, that's a practical problem, but that does not absolve us as a tax auditor to modify our reporting obligations. Our reporting obligations are confined to 3CD. They are confined to the guidance note on tax audit issued by the institute. Let them send notices. If they are sending a notices, that's not our problem as a tax auditor. Because to prevent notices, if we end up modifying the disclosures in the tax audit report, we are actually not performing our professional obligation in discharging the reporting obligations. Wherever there is an interpretational issue available, fair enough, you can take a practical position on reporting. But when the disclosure requirement of the clause is very clear, there is no escaping from the disclosure requirements. That is our professional responsibility as a tax auditor to adhere to the Form 3CD, to adhere to the guidance note of the institute. Clause 18, depreciation. This is something all of us have learned ever since we started learning income tax, how to calculate depreciation for income tax purposes. I'll not take it to the very basics. Everybody knows that depreciation in income tax is on block of asset concept. All assets go into one block. Assets used for 180 days or more, full rate of depreciation. Assets less than 180 days, half rate of depreciation, etc. etc. We'll look at certain practical questions that come up. First, legal ownership versus beneficial ownership. This question commonly comes up in case of partnership firms where the firm has purchased a motor car and the motor car is in the name of the partner but used by the firm. The question is, can the firm claim depreciation in such cases? There is an old Supreme Court judgment in the case of Mysore Minerals on the principle, not on the specific issue, where Supreme Court has said that the term owner for depreciation purposes should be given wide interpretation. So anybody who is an economic owner should be ideally permitted to claim depreciation. But then we have the Mumbai Tribunal judgment, which said that why did the firm not purchase the car in its own name? If there are legitimate reasons for the firm not to purchase the car in its own name, fair enough, we will go by beneficial ownership. Otherwise, we will go by legal ownership. Now, generally, assessees purchase car in individual name and not on the firm name, either because there is a restriction in the Partnership Act or they want to take the benefit of lower taxes. Now, the benefit of lower taxes cannot be a legitimate reason not to purchase the car in the firm's name. Tax department look at it this way, that you're actually abusing the law, getting the best of both. In such cases, depreciation will be given only to the legal owner. There is a circular from CBDT in the context of what to do in case of lease transactions, whether in case of a finance lease, whether the lessor should get depreciation or lessee should get depreciation. CBDT's view in that circular is income tax only recognizes the concept of legal ownership. It does not recognize beneficial ownership. So whoever is on record owner of the asset, only that person will get depreciation. So this question becomes important. Whenever we are claiming depreciation on an asset, it is important for us to look at the title documents to see whether the asset is legitimately owned by the assessee. Put to use. This is a differentiation between accounting and tax. In accounts, the moment you purchase an asset, you start charging depreciation, being efflux of time. But in income tax, depreciation is allowed only when the asset is put to use. So if you see the format of the tax audit report, when you add the particulars of additions to fixed assets, you are required to state date of purchase, date put to use. Now, the institute in its study report of June 22 actually made an observation that in many cases, people have done a copy paste. Whatever is the date of addition is the same date as date put to use, and logically that can't be true. Yes, if you are purchasing assets like laptops or electronic items, you can say the asset is put to use on the same day that it was purchased. But if it is an item of machinery, which involves an element of installation, or take a very common example, air conditioner. You purchase an air conditioner, the air conditioner gets delivered to your place. 1 or 2 days later, the installation happens. Now, in such cases, the date of purchase and date put to use will be different. We have to be diligent about it. Second is, if the asset is actually not put to use, the asset is not eligible for depreciation. So if the asset is only ready to use but not actually used, the asset cannot claim depreciation because the asset is not put to use. There is one exception to the passive use theory. If it is a standby asset, like for example, you have a main generator and you have a backup generator, that if the main generator fails, the backup generator will start. Then in case of a standby asset, that asset can be said as put to use. You can claim depreciation thereon, even though the main generator has never failed. So only in case of standby asset, you can go with the ready to use theory. Otherwise, in all cases, we have to go with put to use theory. Finance lease we already touched upon. Whether using all assets in the block necessary to claim depreciation. Say the block of asset is a pool concept. Once the asset enters into the block, it loses its individual identity. So it's not necessary that all the assets in the block should be used. Even if one of the asset in the block of asset is being used, assessee is eligible to claim depreciation. The put to use criteria is relevant only in the year of purchase, not thereafter. Now let's look at an interesting question. The rate of depreciation for computers is 40%, and the rate of depreciation for plant and machinery is 15%. Now I have given you 3 questions here: printers, scanners, and networking equipment. Whether they should be treated as computers eligible for depreciation at 40%, or should they be treated as plant and machinery eligible for depreciation at 15%. Let's start one by one. Printers. Any views audience can put into the chat box. 15% or 40%? Okay, mixed views. Most of you are suggesting it should be 40%. Amol has given an interesting point that printers, scanners do not perform any arithmetical logical function, so they should be treated as plant and machinery. Krupali is saying there are judgments where printers are considered as computers. Yes. Okay.
40%.
Yeah. So by and large, everybody is saying 40%. There are indeed, most of the courts have taken a view that anything which is exclusively used with the computer, okay, exclusively used, then it should be treated as a part of the mother asset, which is computer. So they should be eligible for depreciation at 40%. But if the asset is not exclusively used with the computer, it should be treated as plant and machinery. I have a different theory here. It's been touched upon in one Mumbai tribunal judgment in case of router mania communications. The question here, therefore, is what is a computer? Right? Computer is not different. Everybody will have their own interpretation. As somebody actually suggested that anything that performs arithmetical logical function is a computer and nothing else. Now, if you look at, there is an old provision under section 36, which deals with Y2K expenditure. Now, Y2K was a unique problem. Some of us may not be aware. When computers came into vogue in 1970s and 1980s, the dates of the computer system were 2-digit. And then everybody realized that, oh, at once year 2000 comes in, the date will reset it to 00. So there was a massive activity of converting the 2-digit date function to a 4-digit date function, which was called Y2K, year 2000. Now, Y2K expenditure was, in that sense, expenditure which would have benefited an SSE for a long period of time. So there was a confusion whether it is capital expenditure or revenue expenditure. To set this controversy to rest, under section 36, they said whatever Y2K expenditure you are incurring, you will be given deduction upfront. And while defining Y2K, they defined something called as a computer system. So we have something called as a computer, and under section 36, we have something called as a computer system. And Mumbai Tribunal in one of the cases has taken a view that computer peripherals, let's say something like a scanner, is a part of a computer system, but it is not a computer. They have taken a view, if you today go and buy a computer, does scanner come by default? It doesn't. Does a keyboard come by default? It does. So a keyboard, mouse, monitor comes by default. So there is some element of ambiguity, though I would concede most of the judgments today are going by the functional test. If printers and scanners are primarily being used as a part of the computer, you can claim depreciation at the rate of 40%, but please bear in mind the matter is not free from doubt. Networking equipment situation becomes very different. Networking equipments are routers, switches, gateways, so on and so forth. So, Wi-Fi extenders, etc. Nobody can take a position that they're exclusively used with computers for the simple reason today you have a Wi-Fi router in your office or at your home. You're using Wi-Fi on the laptop, you're using Wi-Fi on the mobile, you're using Wi-Fi on the TV. The use is not exclusively for computer. Therefore, in my view at least, networking equipment should qualify for depreciation at the rate of 15% as items of plant and machinery, not as computers. The functional test therefore becomes important. So this is just a glimpse of what questions generally could arise when we are looking at filling in certain information in the tax audit. Improvement to leasehold premises. Now we saw in the first point that to claim depreciation you need to be owner. Let us say today I have taken an office on rent and I have done a false ceiling in my office. I have put a nice flooring. I'm not the owner of the office because I've taken the office on rent. So the expenditure that I've incurred on false ceiling and the flooring, no doubt is capital expenditure, but can I claim depreciation thereon, considering the fact that I'm not the owner of the premises? The answer is yes, because there is a specific provision under section 32, which says that if you are doing any structural improvement in a building and you are not the owner of the building, to the extent of that structural improvement, you can claim depreciation. But this is only specific to the extent of buildings. Moving forward, clause 19, business deductions. If you look at the form, there's a long list of deductions. Most of them are inapplicable. I have picked up two, which will by and large be relevant. Section 35, scientific research expenditure. Section 35D, preliminary expenditure. Section 35, basically it gives three benefits. Revenue expenditure incurred on scientific research is allowed as a deduction. Capital expenditure incurred on scientific research, you can claim 100% deduction in the first year itself. And then there is section 35(2)(ab), which provides weighted deduction of 150% of the expenditure, whether revenue or capital. So today, if let's say we have an SSE who comes to us saying that I'm doing scientific research in my office, so I'm eligible for weighted deduction. Can we certify this as a tax auditor that yes, the SSE is eligible for weighted deduction? Anybody, any thoughts? Please put it in the chat box. How do I know as a chartered accountant that what he is doing is scientific research or not a scientific research? Well, the answer is straightforward. We don't have to sit in judgment. Okay, somebody saying we have to obtain technical certification. Okay, the SSC arranges for a technical certification that this is scientific research. Then what? Can I state that relying on technical certification, this is being certified? The answer is, see, there are no free lunches in income tax. Any benefit that is granted to an SSC is always conditional. In case of scientific research expenditure, there is an institution called as DSIR, Department of Scientific and Industrial Research. The SSC has to get his business facility approved from DSIR. DSIR has to quantify that expenditure, and only then it gets into the tax audit report. So any SSC coming to you and saying, I'm doing scientific research, tell him, thank you very much. Please bring me the DSIR report. If there is no DSIR report, I'm not including it in the tax audit. So our job as chartered accountant is straightforward. Let's go by DSIR. Whatever DSIR certifies is scientific research. Next provision is 35D, preliminary expenditure. 35D says preliminary expenditure is expenditure before commencement of business. So whatever expenditure we have incurred before commencement, it is allowed as a deduction in 5 installments from the year of commencement. And it specifies what kind of expenses. So one of those expenses are feasibility study expense. So let's say the SSC has made a payment to Mr. ABC for carrying out feasibility study. And he has paid 5 lakh rupees to the expert. Can I claim deduction for that 5 lakh rupees in 5 equal installments under 35D? Yes, no. Any thoughts? Do put into the chat box. Because this is an area of common misconception. That's why we have taken it up as a part of the discussion here. All right. The key aspect here again is, okay, there is one response, you can claim 1/5. Okay, so 1 lakh per year we can do. Okay. So the question is, SSC pays 5 lakh rupees to Mr. ABC for feasibility study. This is before the commencement of business. This 5 lakh rupees which he has paid, can I claim deduction for it under 35D in 5 equal installments? So one response is yes, 1/5 can be claimed. One response is if the feasibility study is done by himself. Yes, Nilanjan is also saying you can claim it as a deduction. Interesting. Okay. So by and large, people are tending towards yes, subject to limits, it is allowed. Well, answer is no, not allowed. Reason being, 35D deduction gets triggered only if this so-called Mr. ABC, who has conducted a feasibility study, is registered with CBDT. So if you look at the Master Guide to the Income Tax Act, you will find a list of registered institutions. Only if the feasibility study is conducted by a registered institution as so specified, only then it becomes eligible for deduction under section 35D, not otherwise. Subject, of course, to the other aspects of, the limits being there, etc., etc. So just because the payment is being made to a third party, that does not qualify for 35D deduction. We have to examine whether the third party is CBDT registered. Clause 20, employee welfare payments. Two aspects. Clause 20A says that if you have paid an employee any bonus or commission, which was otherwise payable to him as profit or dividend, then that aspect needs to be reported. What does this mean here? This is very common in closely held companies. So let's think about it from a perspective of an SSC who is artificially wanting to reduce taxes. So it's a private limited company, they do their accounts and then they realize there's a lot of profit. So what do? they declare an extraordinary bonus to the director. The director is also the shareholder. Now, the key question here is, this extraordinary bonus that is declared to the director towards the end of the year, is it covered by his terms of employment? Is it covered by a board resolution? Is there anything on record to demonstrate that the director had given some extraordinary superlative performance and for which the bonus has been paid? If yes, you are good. If no, department can tomorrow view it like this, that this bonus that you have declared to him is nothing but you are otherwise going to pay him as dividend. Because whatever would have been the profits, you would have gotten a dividend out of it. Artificially, you are shifting dividend from dividend to expense. And therefore, it would qualify for a disallowance. This is what gets reported under clause 28. Bottom line, just because the client calls it bonus does not make it so. It may be bonus, it may not be bonus. Clause 20b. Whenever you are collecting any amount from employees towards provident fund, superannuation, gratuity, ESI, etc., the employer is under an obligation to deposit it under the relevant fund within specified due date. If there is a delay in depositing, then section 36(1)(5)(a) says that you will not get deduction. So let's say provident fund is collected for the month of June, 1 lakh rupees. It should be deposited by 15 July. If you don't deposit by 15 July, 36(1)(5)(a) says that amount is disallowed. Now the key question here is, if some disallowance so happens because of delayed deposit of employees' contribution to provident fund, is it a permanent disallowance? Or can I say that ultimately I have paid, so whenever I will pay, you give me a deduction? There was a raging controversy on this issue. Some High Court said, yes, ultimately if the payment is made, deduction should be given. Some High Court said, no. If the payment is made beyond the due date, section is very clear, deduction should not be granted. Yes, so there is one view that if it is paid before the due date of filing the return, then it is allowed. And there is another view not allowed as a deduction. Well, thankfully, life is easy now. Finance Act 2021 has clearly made an amendment. If there is a delay in depositing employees' contribution to Provident Fund, or for that matter, any other welfare fund, beyond the due date specified in those legislations, it will result in a permanent disallowance. So if there is a delay, straight away, you should offer it for disallowance. Prior to 2021, yes, there was some ambiguity, you could have taken a different position. Now let's look at another situation, right? We are in the month of August. The PF contribution, okay, one question is whether employee share or employer share. Of course, right now we are talking only about employee share, not the employer share. Now, right now we are in the month of August. So the contribution, employees' contribution to PF for the month of July needs to be deposited within 15 days from end of the month, which means it needs to be deposited by 15th of August. Now, 15th of August is an Independence Day, national holiday. So obviously, nobody is working on 15th August. So what is my due date now? Whether the due date is 14th August or the due date is 16th August. Income Tax Act is silent. Income tax says you go by the due date under the PF. So you go to PF law. Yes. So people are saying 14th August. Anybody, any other view? Anybody taking a very liberal view saying 16? Yes, we've already seen one. 16th August. Okay. Okay. So by and large, everybody saying 14th. Okay. Some people are saying it doesn't matter whether it is Independence Day, due date is 15th, so it has to be 15th. Can anybody put up a rationale? So whatever view you are taking, 14th, 15th, or 16th, what's your rationale? Why are you saying particular date? Why 14th or why 15th or why 16th? Okay, so people are saying it's a public holiday, national holiday, so it should not be included. Okay, one view is, because payment is to be made till 15. Why are you waiting till the last day, right? I mean, you can very well make the payment before that. But right, everything, most of the things in this country happen on the last day. Public holidays are already known. Okay, fair, interesting discussion. Emergency holiday. Okay, fine. No, it's not an emergency holiday. I mean, it's already known. Everybody knows, right? 15th August is a holiday. Okay. So let's examine this. Does the Income Tax Act say anything about this? It does not. It simply says you look at the PF regulation. You look at 15 PF regulations. What do PF regulations say? PF regulations say 15 days. Now, what does one mean? There is another law called as the General Clauses Act, which applies to all fiscal laws. So the General Clauses Act says, if under any fiscal law, exactly, that's what Amol has mentioned here, right? If under any fiscal law, if you have to do a compliance on a particular day, and that day happens to be a holiday, the due date automatically shifts to the next working day. So in this case, for July, the due date will automatically shift to 16th of August. We should report accordingly in the tax audit report with a suitable note that we are relying on Section 10 of the General Clauses Act in terms of considering the due dates. Right? So that's on clause 20. Clause 21, general deductions. So this is the list of what is included here. We are going to look at it, and there are a number of interesting cases here. What gets reported, what does not get reported. So let's talk about capital and personal expenditure. This is a famous interview question, right? What is the difference between capital expenditure and revenue expenditure? How does one distinguish? And common notion is if an expenditure gives me benefit over a period of time, then it tends to be a capital expenditure vis-a-vis an expenditure giving benefit in a short span of time. The way I look at it is any expenditure that gives enduring benefit and results in a creation of an asset is capital expenditure. So two criteria, enduring benefit and creation of an asset. If an expenditure gives me enduring benefit, but no asset gets created, it is still revenue expenditure. Example, you do a heavy advertisement campaign. You are going to get the benefit of the next 3 years, 4 years, 5 years. But it does not result in creation of an asset. Still, it gets qualified as revenue expenditure. Now, expenditure incurred on increasing authorized share capital and share issue expenses. Whenever in company cases, whenever you are increasing the authorized capital, where you are issuing shares, you have to pay mandatory stamp duty, professional fees, etc. Those expenses are also treated as capital expenditure. There's a question in the chat box that should it be treated as deferred revenue expenditure? Deferred revenue is an accounting concept. Income tax is binary. It only understands capital or revenue. So if an expenditure is not capital expenditure, it gets qualified as revenue expenditure. Expenditure on renovation, we already discussed this when we touched upon depreciation, that if I'm doing any structural repairs as a lessee, then those expenses will be capital expenditure. Otherwise, expenditure on renovation, I can very well claim it as revenue expenditure. Now let's come to another interesting question. Application software requiring regular renewal. Let's say annual antivirus software. Capital or revenue?
Revenue.
Okay, let me complicate this further, okay? Because everybody is saying revenue. I take an antivirus subscription for 1 year. I don't renew it after 1 year. What happens to the antivirus subscription? Can I still do the antivirus scanning? Or I'm stopped access to it? Connected example, okay? You go for a tally license. Expires after 1 year, you don't renew it. There's so many of us who are using tally 5.4 and 6.3 and 7.2. Then what happens? Enduring benefit? Of course, when you incur the expenditure and let's say it is for 1 year, and after the end of 1 year, your access is absolutely stopped, then definitely it is revenue expenditure. But if I'm still given access, only thing that is stopped is access to newer functionalities. Then can I say I'm getting enduring benefit? Let's say I'm using Tally 9. Then they came up with Tally Prime, but I'm still using Tally 9. Then what happens? Capital or revenue?
Still revenue.
Okay, still revenue.
Because the object of this is that we are using it for 1 year license type. Means because there will be many assets which can be used even after its shelf life. But primary use object or primary use also we may need to consider, because some reports might not be there, etc. Means it's, I am not able to put it properly.
No, absolutely. See, this is where one goes by the business function test. That whenever you are incurring a particular expenditure, under the normal usage of trade, what is expected? Right? I mean, today, if I buy a packet of chips and I don't eat it for 2 years, that does not mean it is capital expenditure, right? I mean, it's lasted for 2 years, but I have not used it. The business function test basically tells me that if I buy a packet of chips, I am going to consume it the same day or the very next day. Similarly, when I'm buying any software program, and if I'm paying a license fee for 1 year, the intention is manifest that I intend to use it only for 1 year. What I do subsequently is really of no consequence. Therefore, such expenses can be considered as revenue expenses because they have an annual renewal feature. But yes, I mean, department being department, they can still go ahead and dispute this. Key aspect is for routine softwares, etc. We all understand, but sometimes, the softwares become technical. So that is where we have to go back and ask the client that what exactly this software is. And based on that, take a call whether it is revenue expenditure or capital expenditure. Concept of materiality. You buy a calculator of 500 rupees. It is going to last you for 3 years. So capital expenditure or revenue expenditure?
Due to materiality concept, revenue. Otherwise, it should be capital.
Okay. Okay. So let me ask you a question in return. Which provision of the Income Tax Act permits the tax auditor to look at the quantum of expenditure and then take a call whether it is capital or revenue? There used to be an old guidance under the Companies Act 1956, which said items below 5,000 rupees can be expensed out, but that guidance no longer survives after the Companies Act 2013. In fact, it has been expressly taken out. It's illogical, right? Do I now start capitalizing calculators and staplers and whatnot? The crux of the matter is, law is not allowing us to go by the concept of material. Now, this is where we have to marry practicality and law, where we have to make a suitable disclosure in the notes to the tax audit report, saying that material items of capital nature are capitalized. I'm only saying you can take it as a capital expenditure, but then you can take 100% depreciation. Well, Amol, there is no provision, there is no block of assets in income tax that is allowing claiming 100% depreciation thereon. So once you are treating it as a capital expenditure, it will go as an item of plant and machinery, and 15% rate of depreciation would apply. So there is no materiality as far as tax provisions are concerned. We have to exercise our professional judgment. I mean, today, let's look at it this way. An IT company starts purchasing 100 keyboards and similar assets. Then we have to look at what is the usage. Again, the business function test. Do you really have a situation where the asset is consumed during the year? Then it is revenue expenditure. But if the asset is lasting you and the quantum is high, then as an auditor, our professional judgment comes in. Also, a connected important aspect is, see, the certification in tax audit is true and correct. In true and fair, you can say materiality concept is fine, because concept of materiality effectively says that the true and fair view of the financial statement is not vitiated because of non-material items. But in tax audit, it is true and correct. So yes, we have to marry practicality with legality, with suitable notes and disclosures, so that our professional obligation as a tax auditor gets discharged. Personal expenditure. Can a company or a partnership firm have personal expenditure to be reported under this clause? Any thoughts? Or let me put it in terms of an example. The company pays school fees of the director's children. Do you report it as a personal expenditure here? Okay, school fees of director's children paid by the company. The overarching view is saying that yes, it is not, it should not be reported. That's by and large correct, that even if a company or a firm is incurring any expenditure for the personal benefit of the directors or the partners, it is as good as a part of remuneration or a perquisite granted to them. Company or a firm being artificial persons, they can never have personal expenditure. Out of caution, what you can report in the notes to the 3CD is to say that expenditure incurred under contractual commitments with partners or directors are not reported under this clause. But for a company or a firm, it can never have personal expenses. Connected also aspect is, we discussed at the start, right? It is an audit of business. It's not an audit of a person. So even if you're doing a tax audit for an individual, the individual's personal expenses also are not required to be reported. Only those personal expenses which are otherwise debited to business books, they should be reported. So that takes care of general deductions. Now penalty and fine. Now we have some interesting situations here. What constitutes penalty or fine? Simply speaking, any amount that you pay for violation of a law is treated as a penalty or fine. Yeah. 3 questions. Penal interest, whether it will be reported here. Let's say there is a delayed payment of GST. So I'm not a GST expert, but I'm told that the rate of interest is very high on GST. I think it's around 1.5% per month. So you have paid interest on GST, right? Why interest is charged? Because they don't want you to do such delays. So it's more like a deterrent. So interest on GST, whether it will be reported as disallowance under penalty or fine under clause 21. And more importantly, if you look at clause 21 carefully, it has 3 elements. Penalty or fine for violation of a law, any other penalty or fine, and expenditure incurred for an offense or which is prohibited by law. So, interest on delayed payment of GST. Yeah, it could be penal interest charged by the bank also. Okay, everybody saying disallowed. I think I saw only 1 or 2 responses which are saying that it will be allowed as a deduction.
Allowed.
Okay.
My opinion is that it is just like a interest only as a compensatory nature. So it should be allowed, I guess. And I think there are some supporting cases also.
Right. Yes, that's the position. Any interest that you pay, just because the law calls it penal interest, or for that matter, anything else, that will not determine the deductibility. Any interest that is compensatory in nature, which is to compensate for loss of time value of money, such interest is allowed as a deduction. There are 3 or 4 Supreme Court judgments on the issue. Now, how does one decide whether the interest is compensatory? The interest is compensatory if it is calculated with reference to a point of time. Like interest is 1.5% per month, which is linking it to the passage of time. Such interest is not in the nature of fine or penalty. It does not require report. There is a question on interest on income tax. We will come to it when we have a subsequent clause. So there we will deal with whether interest on income tax should be reported. Similarly is the case with compounding fees. Any compounding of offense is basically not an admission of offense. It is still in the nature of payment made without accepting guilt. So even compounding fees are allowed as a deduction. And third question, fees paid for delayed filing of TDS returns, right? 234E, 200 rupees per day. Now this is not compensatory. Delayed filing of TDS, it is not calculated as a percentage. It is 200 rupees per day. Even if the TDS involved is 10,000 rupees or 10 crore rupees, it is still 200 rupees per day. So fees paid for delayed filing of TDS. Okay, people are saying three responses not allowed. Interesting. Okay, the overwhelming view seems to be that disallowed. Is there anyone who says that this is allowed?
I said disallowed.
Vishal is saying it is fees, but yes, it's a fees for delayed filing, right? So when we are looking at fees, we should also look at delayed filing. Yogesh is making an interesting point. Any payment under the Act should be disallowed. So where is the question of claiming deduction? This is definitely paid under the Act. Okay, let's go into the bit of a background here. Okay, when Section 234E was introduced, its constitutional validity was challenged. Its constitutional validity was challenged, saying that it is in the nature of penalty, whereas under the Act there is no appeal mechanism. There is no consideration if there is a reasonable cause for a default, and the amount is 200 rupees irrespective of the quantum of TDS involved or the type of assessment. So the constitutional validity of 234E was challenged on these grounds. Before the High Court, department made a submission saying that this is not in the nature of penalty. Why we are charging this fee? Because if TDS returns are not filed in time, the processing of TDS return gets delayed. We have to run multiple cycles of processing. So there is additional effort involved at our end. To compensate that extra additional effort, we are charging this fee. Now we are using the same argument of the department to take a position that this is ultimately an administrative fee. Somebody made a point that any payment made under the Act should not be allowed as a deduction. But let's say today I go and apply for an additional PAN and I have to pay a PAN application fee. It is still a payment authorized by the Act, but it is not in the nature of penalty. Similarly, for delayed filing of TDS return, one can very well take a position that it should be allowed as a deduction. Department will dispute it probably, but by its own admission, this is not a penalty or fine. So I don't see a obstacle in getting the claim passed in the assessments. Now, another case study, and this is where I want as many people as possible to comment in the chat box. This is something which practically has happened with us. So we were handling an assessment for a manpower supply company. Very clean operations, about 15-20 crores of turnover. Very, very highly governed company. Now, typically in the assessment of a company, department asks for basic information like return of income, computation, tax audit report, financial statements, memorandum articles, etc. And one tends to pick up the documents and submit it to the department. So somebody from our office made the submission, documents were submitted. Then when we go for the hearing, the officer says, if I look at your P&L, you have a 15 crore of sale and you have a 13 crore of expenses. He says, I am going to disallow the entire 13 crores of expenses because you are doing an activity of manpower supply. And when I look at your memorandum, the activity of manpower supply is not stated as one of the main objects or as an incidental object of the company. Now, everybody knows under the Companies Act, your memorandum should have your main object. Whatever you're doing should be your main object. So the officer took a view. You are doing an activity not supported by the memorandum. So this is an illegal activity. So whatever expenses you are incurred is in violation of law. I am disallowing entire debit side of P&L. End of assessment. I don't have to look at anything else. So what are participants' thoughts on this? Allowed, disallowed? Okay, we have one view, two views saying disallowed. Okay, some views are allowed because IT has got nothing to do with memorandum, etc., or it's a separate law. But you look at the language of Section 37. See, income tax penalty by nature is disallowed. They are disallowing any penalty and fine under any other law and any expenditure incurred in violation of any other. So there's no restriction that only if it is an income tax penalty, it will be disallowed. Tomorrow you pay a customs penalty, even that penalty will get disallowed.
Disallowed.
Okay. Well, I can tell you this, on merits, we defended the matter. We had to ultimately appear before the commissioner, but we defended the matter. And our rationale was thus. What does Section 37 do? See, there is no denying the fact that this is a violation of the Companies Act. The requirement is very absolute. My activity that I'm doing should be mentioned in the memorandum. So definitely it's a problem under the Companies Act. However, if you look at Section 37, what does it say? Expenditure incurred for the purpose which is an offense or which is prohibited by law. So if I'm incurring any expenditure for the purpose of an offense, it is disallowed. In my case, the offense has already happened. The day I started doing manpower supply business without writing it in the memorandum, offense has already happened. Now, thereafter, if I do 10 crore expenditure or 50 crore expenditure, offense has already happened. So my expenditure incurred subsequent to the offense cannot be considered as expenditure for the purpose of offense. And on this ground, we could defend it before the commissioner. But yes, I have to admit it was a rude shock for us. It was a rude shock for the client. And we were tensed for a while that, which way the matter is going. Bottom line, see, these documents become very important. 9 out of 10 times, nothing will come out of it. But we have to be diligent while we are doing the tax audit, that what exactly are the documents we are looking at and whether all the documents are in sync with each other. 21B, TDS related disallowances. The disclosures are pretty straightforward. See, what today the provision says, if you're making a payment to somebody on which tax is to be deducted and you have not deducted the tax, then the concerned expenditure gets disallowed. If it is a payment to non-resident, the 100% expenditure gets disallowed. If the payment is to a resident, 30% of the expenditure gets disallowed. But if you have deducted the TDS and paid it till the due date of filing the return, then you can claim it as a deduction. If you have made the payment thereafter, you have deducted TDS today, paid it 2 years later, then whenever you make the payment in that year, you will get it as a deduction. So you complete the compliance and then you claim the deduction. So that's what 21B talks about, that, if there are any disallowances from a TDS deduction perspective, tax auditor is to report that. Now let's look at a few questions around this. 30% we already discussed. So if I have made a professional fee payment of 1 lakh rupees and tax is not been deducted, so 30,000 rupees will get disallowed. Now, let's do an audience poll again. Short deduction of tax. I should have deducted TDS under 194J at the rate of 10%. Right? Yagnik, you have a question. We will cover it in the next question. So your question will get answered there. Right now, we are talking about short deduction of tax. I should have deducted under 194J, but for some reason, I have deducted under 194C. So there is a short deduction of tax. So on 1 lakh rupees of fees that I paid, I should have deducted tax of 10,000 rupees, but I wrongly deducted tax of 2,000 rupees. All other compliances are done. Question is, will there be a disallowance? If yes, how much? Whether the entire 1 lakh will get disallowed or proportionately 80,000 will get disallowed. Okay, Dipendra says disallowed for whole, fine. Okay, proportionate disallowance. Nobody saying no disallowance. 2% तो कट किया है ना? Why should there be a disallowance?
%30 of whole amount.
Okay, so everybody is saying either pro rata disallowance or the whole amount should be considered for disallowance. Nobody is actually taking a view that there should not be any disallowance. Okay. See, first and foremost, this concept of proportionate disallowance is an accountant's concept. I should have deducted at 10%. I have deducted at 2%. So to the extent of 2%, I have complied. And therefore, only 8% I have not deducted. So there should be proportionate disallowance, etc. It has no place in the law. Okay. There are certain supporting judgments which say that if there is a short deduction of tax and the short deduction of tax is because of an interpretational issue, there should not be any disallowance. Because what does section 40 clause A say? That where you are required to deduct tax in accordance with the provisions of chapter 17B and you have not done so, there will be a disallowance. So the question is, how does one interpret that whether the tax deduction is in accordance with the provisions of chapter 17B? Section 194C is also under 17B. 194J is also under 17B. So if I have deducted tax under section 194C, I have still deducted it in accordance with the provisions of chapter 17B. This is SSC's argument. Department says that no, that cannot be the case. Because when the law requires you that deduct tax in accordance with chapter 17B, it is inherent that deduct tax in accordance with the rightful section under chapter 17. In many cases, tribunals have taken a view that so long as there is a tax deduction and the short deduction is on account of an interpretational difference, there should not be any disallowance. So that is one aspect to note. The second aspect is, if I don't go by the first approach, that there should not be any disallowance, while the proportionate disallowance theory does not find place in the law, practically even department is accepting that position. Hypothetical example, let's say today, in the first instance, I said if there is some TDS deduction, there should not be disallowance. So instead of deducting 10%, I deduct TDS at 0.01%. And then I say I've deducted it as per chapter 17B. In that case, yes, there will be a full disallowance because there is no provision under chapter 17B applicable to the facts of my case where one could possibly apply 0.0. So it's open to interpretation. You can very well take a call that if there is a short deduction of tax because of an interpretational difference, there should not be any disallowance. But if the facts are so obvious, you are making a payment to an auditor and deducting under 194, say, there, of course, there will be a disallowance. Amol is asking a question: if I have forgotten to deduct tax, and during the course of the tax audit, I come to know that yes, I have forgotten to deduct and books are closed, then is it permanent disallowance? No. Under TDS related matters, there is no permanent disallowance. If you commit a default, there is a disallowance. Whenever you make good the default, you will get a deduction. Now, somebody was asking this question earlier, and I said we'll take this up a little later. Say for financial year 21-22, TDS was deducted on 1st April 22, Amol's case, right? Books are closed for last year. So I've deducted the tax on 1st April 22, and I have deposited it within the due date of filing the return. That is 30th June 22, whether there should be any disallowance. Anybody, any view? That I have ultimately paid within the due date of filing the return. Okay, one view is there should not be any disallowance. Another view is disallowed in this year, but then next year you will get a deduction. Okay, Sagar is saying if it is on account of interpretational issues, oh, it's a different question. Sorry. Okay, Kanish says no disallowance. Okay, interesting. The response here is there will be a disallowance in the first year. See, the extended time limit to deposit the TDS till the due date of filing the return is allowed only in case there is a default in payment. The extended time period is not allowed if there is a default in deduction. If you have deducted the tax in the year, but only you have not paid it and you are paying it till the due date of filing the return, you will not, the expense will not be disallowed. But if your basic compliance, you have failed to deduct the TDS itself, then obviously the consequences of non-deduction would follow. There will be a disallowance in the first year, but because you have deducted and deposited in the second year, you will get a claim. Consultant versus employee. Right? You see a professional fee payment made to Mr. ABC 20 lakh rupees, tax deducted at 10%, 2 lakh rupees. You feel tax has been deducted. But we still need to examine this again. Devendra, give me 5 minutes. After we complete this clause, we'll again come back to that example. So we are right now on the consultant versus employee issue. 20 lakhs paid, 10% tax deducted, 2 lakhs. On the prima facie looks good. But we need to inquire as a tax auditor that whether this person who is deriving 20 lakh rupees remuneration, is he functioning as an employee or is functioning as a consultant? There have been cases where people have, been functioning as an employee, but for record purpose, they are shown as a consultant. So we need to inquire into the contractual aspects, whether this person is given health insurance from the company, whether he's taking Saturday, Sundays off, whether he's required to adhere to the office timing. If the answer to all the three is yes, then there are good indicators that, he's functioning as good as he is an employee, but only for record purposes, he's been called as a consultant. In which case, because his compensation is 20 lakhs and tax deducted is 10%, if he was an employee, his tax deduction would have been higher. Again, we end up into the same question of short deduction of TDS. So just because you see 10% tax deducted, that does not mean things are fine. The next level of inquiry is necessary. Okay, there are a few questions in the chat box. I'll just finish this slide and then we'll go to them one by one. Car rental charges. Now, whether TDS applies on car rental and under which section, 194C or 194I? Any thoughts?
194C.
Largely, people are saying 194C. I feel differently. What does 194C cover? 194C covers carriage of goods or passengers. And 194I says rent paid for hiring machinery or plant. Car is a machinery or. So seemingly 194C also is covering it and 194I is also covering it. The answer is it depends on the nature of the car rent. When we look at carriage of goods or passengers, we are actually looking at a point-to-point transportation. I am traveling from Pune to Satara. I take Vinathamba bus, point to point, right? I cannot tell the driver, you take via this town or you take via that town. There is a pre-decided route. He is going to take the pre-decided route. That's a point-to-point transfer. That's a contract of carriage of passengers. But today, if I hire a private car, I can tell him, you stop at Kailas, I want to have a nice meal there. Then you stop at Shirwal, I want to have vada pav. You take it to this town, you take it to that town. The vehicle is under my control. Once the vehicle is under my control, it becomes a case of hiring machinery or plant. So it depends on the term of hire. Ola or Uber, right? Typically, an Uber driver will not deviate from the allotted route. That's a case of carriage of passengers. And there is a direct support on this. There is a Supreme Court judgment in the case of Gosalia shipping, where the court has clearly explained there is something called as a time charter and there is something called as a voyage charter. Under voyage charter, it's a point-to-point transportation. Under time charter, the vehicle is under your disposal. So wherever the vehicle is under your disposal, 194I would apply. Where the vehicle is not under your disposal, 194C would apply. So based on that, we have to take a call. Maintenance contracts. 194C says contract for carrying out any work. 194J says fees paid for technical service. And what is a technical service? Any managerial consultancy technical service. So let's say today the AC in my office goes off and I call a technician who actually needs to have a technical knowledge to repair the AC. Whether the payment made to him is under 194C or 194J. Okay, initial views are 194C. Why not 194J? Why it should not be called as fees for technical service? He's doing a technical job at the end of the day. And the dividing line is, as a payer, what am I interested in? Okay, so Khushi is saying if he holds any degree. Now, do you actually ask when an AC repairman comes to your office that, boss, tell me, do you hold a degree? Then I have to deduct TDS. So not holding a degree, then I'll deduct it 2%. The dividing line is, as a payer, am I interested in getting the work done or getting a technical service? When my AC goes off, I am interested in getting the AC fixed. So for me, it is a contract of getting the work done. So what I'm paying to him is a payment for carrying out any work. That's why it is 194C. But if I tomorrow have a contract where I tell him, you show me what you're doing in my AC, so that next time it goes off, I'll be able to fix myself, then I'm getting a technical service, it ships under 194C. Come to think of it, any maintenance activity, even if if the tire of your car goes flat and you have to take out the puncture, even the puncture wala has to have technical knowledge that how to take out the puncture. That's not a dividing line. Dividing line is what I am interested in as a payer. Am I interested in getting the work done? Then it is 194C. Am I interested in understanding how the work is being done? Then it is 194G. Of course, we once had a client who told us that by this logic, the professional fee that he pays us should be under 194C because he doesn't care what we do. He only cares in getting the work done. Of course, the logic cannot be stretched to that extent. In common parlance, this should be the dividing line between 94C and 94G. TDS is a topic by itself. I just thought I'll just take a very broad overview of why we need to do it. Now let's come back to the questions that people have put up in the chat box, which I said we'll take on later. So one question is, TDS was deducted and paid in 21-22. 26Q was filed in 22-23. Whether there will be a disallowance. Let's look at the law. What does the law say? If you have deducted and paid TDS, there is no disallowance. Does the law anywhere say you deduct TDS, you pay TDS, and you file the TDS return, then you'll be given deduction? Right? So the requirement of filing the TDS return is not a condition imposed by the law. So whether you file 26Q in this year or next year, or you don't file it at all, that will not impact deduction. Sagar is asking if the short deduction is not on account of interpretational issues. I mean, you've simply missed out. Then whether the disallowance should be restricted. See, the 30% is of the total amount. The question here is, on what amount do I apply 30%? The 30% will stay. So in the example that I gave, 1 lakh rupees paid, TDS deducted at 2% instead of 10%. The question is, I calculate 30% on 1 lakh or I calculate 30% on 80,000. I have to calculate 30% because that's the absolute requirement of the law. Now, within 1 lakh and 80,000, if the disallowance, if the short deduction is on account of pure miss out, my view is the whole amount gets disallowed. I mean, you have to calculate 30% on the entire 1 lakh. If it is on account of interpretational issue, then it's up to you. Either you can say that I will not make any disallowance, or I will make a disallowance on a proportionate basis. Even though, let me tell you this, department many times does not get into whether the short deduction is on account of interpretational issues or otherwise. They are by and large accepting the proportionate theory, but that is out of convention, not because of the law supporting it. Clause 21, other clauses, we will just skim through this. 48.3. Those of us who are handling individual cases more will face this question. 48.3 says cash payment in excess of 10,000 rupees will be disallowed. So let's say property tax of business premises paid in cash, 50,000 rupees, whether you will disallow. Because the question becomes relevant because there is an exception in Rule 6DD, which says that, even if there is a cash payment, but if it is covered by Rule 6DD, there should not be a disallowance. So the question is, you have paid property tax, it's a government due, 50,000 rupees paid in cash. Allowed, disallowed. Samir, I'm not very clear when you say no, whether it is allowed or disallowed. So it will help if you can clarify it is allowed or disallowed. Okay, Samir says allowed. Thanks, Samir, for that. Okay. The majority view, except for Amol, is that it should be allowed. Well, I tend to agree with Amol. It is not the case that every government due paid in cash is allowed. Rule 6DD carves out an exception that if you are making a payment to the government where the payment is compulsorily required to be paid by legal tender, government plus compulsory requirement of legal tender. Now, in property tax, government does not make it compulsory to you that you pay in cash. You have the option of paying it electronically. You have an option of paying it through DD. So even though it is a government due, because there is no obligation that you have to pay it in cash, it will be still disallowed. Set off of creditor against debtor. So you have to pay me 40 rupees and I have to pay you 20 rupees. So what I do, instead of paying you 20 rupees, I debit your account. Effectively, it's a payment. So whether any disallowance will arise? Allowable? Yes, because there is no payment in cash only. It's another matter that it has been settled by book entry. But So long as there is no cash payment, disallowance should not come. Okay. Payment made to milkman. Allowed, disallowed. And we're assuming, of course, it's more than 10,000 rupees. Okay, again, mixed views, but by and large, people seem to be saying allowed. I'm only saying agricultural activity, so it is allowed. Fine. The catch is, Rule 6DD says that if you are making a payment in cash in excess of 10,000 rupees for purchase of an agricultural produce from the producer, then you are exempt. So really speaking, the answer to this question is you have to go and ask the milkman that are you milking your own cows or you're buying the milk from somebody and selling it to us? Because if he's milking his own cows, then it is an agricultural activity and therefore no disallowance. But if he's buying the milk from somebody else and paying it to us, giving it to us, then he's functioning as a trader. He's not doing any agriculture or animal husbandry activity by himself, in which case it will be disallowed. Of course, practically you will not get these situations very often, but this is only to put the point across that let's look at Rule 6DD very, very minutely. By practice or by convention, we tend to assume certain things that, okay, agricultural activity is exempted, but that's not the case. You should look at the provision very minutely before taking a call. 3613. I thought we are more than 2 hours into the session. Rishikesh has not been kind enough to offer us any refreshments because of the online mode. So I thought, at least let's satisfy our taste buds pictorially. What does 3613 say? 3613 says that if you are incurring any interest expense for purchase of an asset, then till the time the asset is put to use, the interest expense is not allowed as a deduction. It gets capitalized. Now, yes, today if I know that I have taken a loan on 1st of April, I have purchased the asset on 1st of May, then the interest for the month of April, I have to load it onto the cost of the asset. But practically, you rarely get such linear equations. Typically, your client will have a working capital account. All expenses get incurred from that account. So everything is like a mixture. You cannot really separate that, what goes towards asset and what goes towards revenue expenditure. So you have mixed funds. So what do you do in case of a mixed fund? Secondly, you have a working capital account. You have a current account otherwise. So you have own funds also, you have mixed funds also. So what does one do? Well, the mixed fund theory or own fund theory has got a lot of support under Section 14A in case of disallowances linked to exempt income. Courts have said that by and large, if you have sufficient funds of your own, then the presumption will be that own funds are used to purchase assets and loan funds are used for other business purposes. So there should not be any disallowance there. So as a tax auditor, what we have to see is there a direct correlation available between borrowing and asset? If yes, work out the disallowance, report it as a disallowance. If direct correlation is not available and the assessee has adequate own funds, then there is no question of any disallowance. We have to presume that own funds were used for purchase of assets. Clauses 22 to 25. Interest payable. Okay, there's one question in one of the order. AO says that there is no color to funds. When it goes into a pool of fund, it funds only and proportionate disallowance of funds taken. Yes, I mean, that's the old notion. Money has no color. So when money has no color, that's basically the AO trying to apply mixed fund theory, that there should be proportionate disallowance. But mixed fund theory has been superseded by own fund theory in a series of judgments. So if you have adequate own funds, no question of disallowance. If you do not have adequate own funds, then you have to go by mixed fund theory and do a proportionate disallowance. Okay. Interest admissible under Section 23 of MSMED Act. Let me give you a background what this is. There is a separate law called Micro, Small and Medium Enterprises Development Act, which defines which enterprises are called micro, small and medium enterprise, depending on investment in plant and machinery and turnover. So if an enterprise is covered as a micro, small or medium enterprise under the MSMED Act, any person dealing with such an enterprise is required to make payment within 45 days. If they don't make payment within 45 days, they have to pay interest as per the rate specified under the MSMED. We are talking about whether that interest which becomes payable as per the MSMED Act, whether that interest is allowable as a deduction. Now, clause 22 requires you to report. If any interest is inadmissible, then you report. Income Tax Act says nothing about MSMED. But there is an overarching provision under the MSMED Act which says any interest you become liable to pay under the MSMED Act, you will not get deduction under income tax. So MSMED Act overrides Income Tax Act and says that this interest will not be allowed as a deduction, which is what we have to report under clause 22. Clause 23, related parties. It is a factual reporting. Department is interested in getting information about payments to related parties so that they can examine whether the payment is reasonable or excessive. If they find the payment is excessive, they will disallow the expenditure. We don't have to get into reasonability as a tax auditor. We have to do a factual reporting. If 1 crore rupees is paid to the director, 1 crore is paid. We have to report the fact. The clause says report payment to related parties. So the question is, what is payment? Do I go by accrual or do I go by actual payment? Their payment will mean paid or accrued as per the method of accounting. Whatever gets debited to the P&L or whatever is the transaction accounted for in the year, that should be reported here. So that way, it's a very straightforward reporting. All payments to related parties should qualify for reporting here. Clause 25. Profits chargeable under Section 41. Let's say there is a creditor appearing in the balance sheet and the amount is appearing as payable to the creditor for last 5 years. But the SEC says, no, I am going to pay him. Whether such a creditor will require reporting under Section 41, whether any income arises which is chargeable to tax under Section 41. The payment is outstanding for 5 years, no movement is happened. Any thoughts? Nobody, no thoughts? Okay, let me tell you what Section 41 says. Section 41 says that if there is a remission or a cessation of a liability for which you have claimed a deduction earlier, and now the liability no longer exists, then the cessation of the liability should be offered to tax. So if I purchase something for 100 rupees, I pass an entry purchases debit to creditors 100. I have claimed deduction for this 100. And subsequently, I don't make a payment to the creditor. Then really speaking, the expenditure did not come about. But because I have claimed a deduction for 100, the liability of 100 rupees which got waived off, that should be offered to tax. So here, you see a creditor which is not moved for 5 years. Do you report under clause 25 saying that this is taxable under 41? As a tax auditor in a situation, okay, the question is how deduction in respect of creditors will be taken. See, when you accounted the creditor, the debit effect was purchases. You have claimed deduction for the purchases. Now, it is the credit side that we are talking about, that if you are ultimately not going to pay to the creditor, there is no real expenditure, but still you ended up getting a deduction for 100. That deduction needs to be reversed. See, as a tax auditor, we definitely need to inquire into these circumstances, that what is the real possibility that the assessee is going to make a payment? If we find adequate evidence that yes, there is a real possibility that the assessee will make a payment, then whether it is outstanding for 3 years, 5 years, 7 years, doesn't matter. It does not become income. But if there is no realistic possibility of making the payment, and one indicator would be the other party has not asked for the payment in 5 years. So in all probability, you would have forgotten about it. Then even if the amount is not credited to P&L, we should still do this under section 41. That is the onus cast upon us as a tax auditor to examine whether there are any such creditors or liabilities giving rise to income chargeable under 41. Second is, certain amounts are written back in the normal course of business, and then they are credited to P&L. So amounts which are written back in the normal course of business and they are already forming part of P&L, whether you should report it under clause 25. It is already credited to P&L. What do you do? The guidance note on tax audit says even if it is credited to P&L, you need to report it. With due respect to the guidance note, I am of the view that if it is already credited to P&L, going by the spirit of clause 25, one may take a position of not reporting it with a suitable disclosure that they are already credited to P&L, so effectively offered to tax, so not reported again under clause 25. But please be informed, as per the institute's guidance note, even if the matter amounts are credited to P&L in the ordinary course, you still need to report it under clause 25. 43B. All of us would know this is as connected to elementary as depreciation. Section 43B says that there are certain payments, statutory dues, employer dues, etc. You get a deduction only on actual payment. If you make the payment till the due date of filing the return, you will get a deduction. If you don't make the payment till due date of filing the return, then whenever you make the payment, you will get a deduction. Now, advance payments, whether they are eligible for deduction under section 43B, yes, there are enough judgments that are available that even advance payments can be considered for deduction under 43B. 40A7 versus 43B, this confusion commonly comes in case of gratuity and superannuation, where the gratuity fund is an approved fund, you report it under 43B. Where the gratuity fund is not an approved fund, you are simply making a provision based on actuarial valuation, you report it under 40A7. Now, we said payment should be made till the due date of filing the return. Which due date do I consider? Due date for original return or due date of belated return? Because belated return is also return. Yes, the answer is original because 43B very clearly says payment made within the due date as specified in section 139 subsection 1. There is a question from Amol whether profession tax deducted from employee's salary is any tax covered under section 43B or is it covered under section 36? See, when the employer deducts professional tax from the employee, it does not get covered under section 36 because it is not paid in to any labor welfare fund. It is still the employer's obligation to deposit it as a statutory due. So such professional tax do not covered under 3615A. It gets covered under 43B. If the employer is made the payment within the due date of filing the return, he will get a deduction under 43. Okay. Now I have put a question here. Bonus payable on 31st March was 100 rupees. A provision was made. On 10th April, 70 rupees were paid and 30 rupees were reversed. Okay, so the entire 100 became 0 on 10th April. Whether any disallowance will come under 43B? Okay. This is interesting, right? For every question, we have diametrically opposite views. So we have two responses saying no disallowance, two responses saying disallowed. Okay. The interesting part here is the basic provision of 43B says deduction on actual payment. So 100 rupees was payable as on 31st March 22, 70 was actually paid. I think there's no confusion on 70, that should be allowed as a deduction. Then the proviso to 43B subsection 1 goes ahead and says that if you have not paid it during the previous year, but if you have paid it till the due date of filing the return, deduction will be allowed. So the extended time for making the payment till the due date of filing the return is allowed only for actual payment cases. Now, if you take out that proviso, 43B subsection 1 simply says pay during the year and claim it as a deduction. Now, whether 30 rupees has been claimed, has been paid, 30 rupees is not being paid. So it does not fit into the benefit of proviso to 43B subsection 1. 30 rupees will get disallowed in financial year 21-22 because it is right back, it is not actual payment. Next year, that is 22-23, these 30 rupees which is credited to P&L will not become part of income because it was not claimed as a deduction earlier. The point on leave encashment is a different conversation. So for the want of time, I'm not touching upon it at the moment. Clause 27A talks about SENVAT credit. You give particulars of opening balance of input tax credit, additions, deletions, and ITC at the end of the year. Naturally, these reconciliations have to tie up with your GST records. If there are differences, you should have reconciliation for those differences. Prior period expenditure. Whether an assessee who follows cash system of accounting, can an assessee following cash system of accounting have prior period expenditure? Logically, no, because prior period expenditure and expenditure arising on account of error or omission of the earlier years. Now, somebody who's following cash system of accounting, so long as the cash balance and the bank balance are timed, then there is no question of prior period expenditure coming in. On the earlier point, there's a question from Kunal. Deduction for 70 will be allowed in which year? It will be allowed in financial year 21-22 itself. (29B) Particulars of income taxable under 56(2)(10). So what does 56(2)(10) say? That if you receive a property for inadequate consideration, say something is worth 100 rupees, you got it at 60 rupees. So 40 rupees is the inadequacy of the consideration. So effectively, you are getting benefited by 40 rupees. That 40 rupees becomes taxable as income from other sources, which is what we have to investigate and report. That if 56(2)(10) is applicable, assessee has received a property for inadequate consideration, then the fact should be reported. This is the example that I've given. Property of 100 received for 30. There's a correction here. Property of 100 received for 30. Income from other sources will be 70, not 30. Now, what kind of property? Immovable property, that is land, building, shares in securities, jewelry, archaeological collections, work of art, and bullion. Now there's a trick question, okay? So it's not as straightforward as this. A car of 30 lakhs was purchased by the SSE for 10 lakhs. Will you report it under 56(2)(10)? That's the question. Okay, two responses which say no. Correct. So it will not be reported under 56(2)(10) because if you look at the definition of property, it does not include machinery or plant. So car is not property within the meaning of 56(2)(10). But can you think of any other clause where it will get reported? Possibly could get reported? No, not 50C, because 50C is applicable only for land or building. It does not cover machinery or plant. Yes, Agni gift, but it's not already not covered under 56(2)(10). We've already seen that, so it can't be reported as a gift. Well, it could possibly get reported under clause 16A. Items falling within the meaning of section 28 not credited to profit and loss account. So the point of inquiry has to be that why did the SSE, what were the circumstances that the car of 30 lakhs could be received for 10 lakh rupees? Is it that the car was purchased from a client of the SSE or a customer of the SSE, and to square off a business transaction, instead of 30 lakh rupees, the car was sold at 10 lakh rupees? If the answer is yes, then to the extent of difference of 20, it becomes a non-monetary benefit arising from business or profession, chargeable to tax under 28(4), requiring reporting under 16A. So definitely not 56(2)(10). So definitely not under clause 29B, but possibly under clause 16A. So wherever you are seeing SSEs doing any purchases, we need to actually inquire whether the purchases are aligned to the fair market value or the purchases are at a significantly discounted rate. Okay. Now let's look at the next one. I mean, there is a reason why I have put a dangerous looking hydra on the screen. So what you're seeing on the left side of the screen, the image of a dragon, which is basically a hydra, is what the next clause is all about. And the image that you see on the right hand side of the screen is the tax auditor, who is still calm and composed even though he has a hydra sitting next to him. Why do I say so? Because now we are going to be talking about clause 30C, and it will be new for a lot of us. This clause was inserted about 4 years ago in the tax audit report, and every year the application of that clause was delayed. So the application of the clause was deferred till 31st March 22, which no longer applies. So we have to now look at clause 30C very closely, very actively. Before we get into the contents on the slide, the concept is whether the SSE has done a transaction which attracts general anti-avoidance rules, GAAR or GAR for short. If the SSE has entered into a tax avoidance transaction covered under GAR, as a tax auditor, we have a reporting obligation. GAR is a topic by itself. We need to have another maybe a 3 or 4 hour session only to talk about GAR. But within the limited time available, I'll just give you a quick overview. Clause 30C, clause A, says whether the SSE has entered into an impermissible avoidance arrangement. These are the keywords: impermissible avoidance arrangement. Simply speaking, any artificial tax planning, any tax evasion, any quote-unquote cute transactions done by the SSE are in the nature of impermissible avoidance arrangement. This is tax avoidance or a tax evasion. It is our responsibility as a tax auditor to wear the hat of an investigator and examine whether the assessee has done any artificial transaction where 𝐸 can apply. It's a very onerous responsibility. What we have to specify today, if you find an assessee who's done an artificial tax planning mechanism, we have to disclose the nature of the arrangement, and we have to disclose what is the tax benefit arising from that arrangement. Let's see what this impermissible avoidance arrangement is. Defined under section 96. Any dealing or arrangement which is not at arm's length, which results into misuse or abuse of the provisions of the Act, which lacks commercial substance, or which is deemed to lack commercial substance. What is the deeming fiction? Again, under section 97, instances have been provided. Or a transaction which is entered into or carried out in a manner which is not ordinarily employed for bona fide purpose. It makes it an impermissible avoidance arrangement. So, going back, any transaction not at arm's length, which abuses the provisions of the Act, does not have commercial substance, or is deemed not to have commercial substance, or is done in a manner which is not ordinarily done. If any of these 5 triggers are triggered, any of the 5, it can qualify as an impermissible avoidance arrangement, casting a reporting obligation on the tax auditor. Furthermore, section 96 subsection 2 goes ahead and says, if in any arrangement there are different parts, and if one part is impermissible, the whole arrangement is impermissible, unless you are able to prove otherwise. What are transactions which deemed to lack commercial substance? Any step in an arrangement is inconsistent with the whole transaction. Round trip financing. So A pays to B, B pays to C, C pays to D, and D returns it back to A. So it's a circuitous route. Involves an accommodating party. So the example that I gave, A pays to B, B pays to C. What is B doing? B is receiving, B is paying. Accommodating party. Has got no substance of his own. Elements that offset or cancel each other. Same thing. A to B, B to C, C to D, D to A. So entire transaction gets offset. Or disguises the value, source, location, ownership, or control of funds. Or involves an asset or person primarily to obtain tax benefit. Or does not significantly impact business or net cash flow except for the tax benefit. It is an arrangement deemed to lack commercial substance. Complicated? For the sake of understanding, any artificial tax avoidance measure is an impermissible avoidance arrangement. What is commonly quote unquote called as tax planning. Sir, kuch tax planning karo aur mera tax kam karo. That is actually an impermissible avoidance arrangement. We as a tax auditor need to report. Right? So we are not only a tax auditor. In my view, clause 30C makes us a tax investigator, not a tax auditor. Thankfully, there is Rule 10U. Rule 10U says that Chapter 10A dealing with 𝐸. Yes, Sagar, I'll give you some real life examples. I was just waiting for everybody to digest this. It's quite complicated to absorb. Rule 10U says Chapter 10A dealing with 𝐸 will not apply if the tax benefit is below 3 crores. Now here is the catch. Rule 10U says 𝐸 will not apply if the tax benefit is below 3 crores. But it does not say if the tax benefit is below 3 crores, it is not an impermissible avoidance. And what does clause 30C say? It does not say whether 𝐸 applies. It says whether it is an impermissible avoidance arrangement. 𝐸 may apply, 𝐸 may not apply. So two views exist here. One view is department wants us to report all impermissible avoidance arrangement so that department has the data to examine whether the 3 crore limit is met or not. That is view 1. And view 2 is, if the tax benefit is below 3 crores, GAR itself will not apply. So why should I report? Both views are equally possible. We have to consciously take a view to decide whether you go by view 1, which your client is not going to like, but which is more closely aligned to the spirit of clause 30C, or you have to go by view 2, saying that if the benefit is below 3 crores, GAR does not apply, so I will not. Hand on the law book, view 1 is a better view, but it's a practically dangerous view. That, in a nutshell, was 30C is talking about. Now, let's come to some real life examples to see where arrangements actually lack commercial substance. There is a provision called Section 79, which says in a private limited company which is into losses, if there is a change in shareholding by more than 49%, you lose the benefit of carry forward of loss. So what do people artificially do is, I want to transfer control of the company. So I will transfer entire shares, but on record, if I transfer all the shares, the benefit of losses is lost. So what I do an agreement saying, I will give you 10% stake every year, and I give effect to the transaction only after the losses are set off. But I take the payment upfront. I agree with the purchaser that while I transfer the payment shares in 10% installments, you will have all the voting rights. Now what is happening here? On record, I have still not transferred the shares, but the other party has paid me everything and I have agreed to vote as per his directions. Let's go back. Okay. Does the arrangement lack commercial substance? It does. Nobody will make payment to me upfront when I'm transferring the shares in 5 years. Right? Does it deem to lack commercial substance? Yes. Steps in the arrangement are inconsistent with the whole arrangement. What is the whole arrangement? I'm selling the company. But what steps I'm taking? I'm taking a step that I will transfer it in 5 installments. Disguises the value, source, location, ownership, or control of funds. It does. And primarily to obtain a tax benefit. So this is one example where GAR could apply. Now, based on this example would have also seemed complicated, right? This is what the real life is going to be. Gone are the days of very elementary tax planning of shifting sales from one file to another. This is the real tax planning or tax evasion that happens as on date. So we have to really investigate into each and every arrangement to examine whether we need to report anything there. Now, there are a couple of questions. Many times JVs are formed to get the work done due to bid capacity in a civil contract. Work is subcontracted to other party on a back-to-back basis. So no margin is kept in JV. So now, is JV only an accommodating party? I would say whether there is a tax benefit. Primarily, one will look at that. Is there a tax benefit being enjoyed by anybody? If the answer is no, then there is no question of GAR being applied. Then it's not an impermissible avoidance arrangement. Impermissible avoidance arrangement becomes relevant only when there is a tax avoidance or a tax evasion involved. Right. Now we have a few minutes left on the clock. So 269SS, 269ST, and 269T, I have included detailed slides on what needs to be reported. So I'll not take you the slides one by one, but it typically talks about transactions in cash above 20,000 rupees or 2 lakh rupees. One question from Mohammed, whether reporting under this clause would have to be done as utility says it is deferred till 31st March 22. So that's the catch. Reporting under clause 30C is deferred till 31st March 22. Now, all the dates, if you look at the history from 2018 to 2022, all the dates correspond to the date of issuance of the tax audit report. So reports issued up to 31st March 22, you don't have to report anything under 30C. But once 31st March 22 is over, any report issued after 31st March 22, 30C reporting will apply. Similarly, on GST, we will come to clause 44. Clause 44 reporting will also apply. Clause 32, brought forward loss. You have to report the particulars of brought forward loss, whether it should be as per return of income or should it be as per the assessment order. Well, the answer is, if the SSE is contesting any additions made, you should still go by the SSE, you go by the return loss. But if the SSE has accepted the addition that has been made, then you go by the assessed loss. So there is one more question. Traveling advance to employee in bank 30,000 rupees, and when booking expense, you are booking, okay, I think there's a lot of accounting jugglery, 30,000 is given back, etc., etc., etc. And then booking expense of 22,000, 269 SS applicable? Yagnik, my answer is no. 269 SS covers loan or deposit. It does not cover transactions of advance. Clause 34 on TDS. Reconciliation of TDS. You report whatever expenses are debited in P&L. On that, whether tax is properly deducted or not. If there is a delay, non-depositing of TDS, then those amounts have to be reported. Practically, this information is to be extracted from TDS returns, and to the extent possible, you should reconcile it with the profit and loss statement. I am purposely using the words to the extent possible because it may not be possible all the time. So to the extent reasonably possible, you should do it, and then take a call as to whether you need to insert or disclaim your position with suitable notes and disclosures. There's one more question. TDS to be deducted on provisions, whether it is mandatory. Yes, TDS to be deducted on provisions. It is definitely mandatory. In fact, if you see the judgments on this issue, even courts are tending towards the view that if you are creating a provision on which TDS is to be deducted, then you should deduct the TDS. There is only one judgment of the Mumbai tribunal in IDBI's case, which is on a very peculiar fact, which says that if you are creating a provision where the identity of the payee or the other party is not known, then okay, you can take a position that TDS deduction does not apply. But this position is based on a judgment. Provision of the law is very absolute. If you're creating a provision, TDS deduction should be done. One more question, whether clause 44 is applicable for assessment year 22-23. Yes, it is applicable for the reasons that I cited. What should be reported, we will discuss when we come to clause 44. I'll take 10 minutes extra. I'm only compensating for the technical glitch that we had, which we had to give up about 5-10 minutes. So in the next 10 minutes, I think we should be able to wrap up. 34B, timely submission of TDS returns. What it says, you have to report whether TDS returns are filed in time. If yes, if the TDS returns are filed in time, end of story. You don't have to bother about anything. But if there is a delay in filing TDS return, then you have an additional obligation. Then you have to go back and check whether the TDS returns are correctly filed. Right? So if TDS returns are filed in time, you don't have to bother whether they're correctly filed or not filed. But if there is a delay, then you have to examine whether it is correctly filed and report yes or no as the case may be. 34C, reporting of interest on TDS. Interest on TDS, the question here is, do I go by interest applicable for transactions of 21-22, or do I go by interest debited in the accounts for 21-22? In my view, a more practical approach and a prudent approach is to go by interest debited in the accounts of financial year 21-22, no matter to which year it relates. So even if you get a TDS default for financial year 18-19, which you ultimately close by payment of interest in 21-22, it should be reported in the tax audit of 21-22. Quantitative details, very crucial. You need to ensure that the quantitative information that goes into the tax audit report is otherwise consistent. The ratios appear consistent. There are no wide fluctuations year on year. For want of time, clause 36A I will skip for deemed dividend, but anyways, the discussion is already there on the slide. Clause 40 and 41. Clause 40, you have to report ratios, gross profit and net profit ratio, inventory turnover, and material consumption ratio. Now, these ratios become very crucial because, rightly or wrongly, department has a difficulty accepting that your gross profit ratio has gone down. So if in the first year you say my gross profit ratio is 10%, and in the second year, your gross profit ratio goes down to 8%. If the matter is selected for scrutiny, invariably department will come and ask, explain why the GP ratio has come down by 2%. And if you're not able to satisfactorily explain, they will make an addition for the 2% fall in the GP ratio. Okay. So he has to be careful. One has to be careful while reporting the ratios here. Similarly, under clause 41, we have to report demands and refunds under other laws. This is basically information for the department to identify if there have been demands raised under other laws, then whether those demands include any element of penalty and whether that penalty is debited to P&L. Similarly, if there are refunds issued under other laws and those refunds are granted with interest, whether that interest has been offered to tax. Clause 42, filing of statement of financial transactions. We have to report whether the SFT filing has been correctly done. SFT filing applies primarily to issue of shares, issuance of debentures, and cash transactions above a particular threshold. Last clause 44 on GST reporting, and then I will go to a couple of open questions on the chat box. Similar to clause 30C, this is a new reporting requirement. It was deferred till 31st March 22, which applies to reports given up to 31st March 22. So now this clause has become alive. It is very much operational. What do we have to report? We have to report total expenditure and bifurcate that expenditure between four categories. One, expenses relating to goods and services exempted from GST. Actually, the term exempt is a misnomer. It should be non-taxable as well as exempt under GST. Classic example, power and fuel, not leviable to GST. So electricity charges will get reported. Then, once your expenditure is split between, once you have identified goods that are exempted from GST, then expenses on which GST has been charged to you, that expense has to be bifurcated between GST charged by composition dealers and GST charged by regular dealers. So typically cases where GST has been charged but you have not taken input tax credit because the dealer is under a composition scheme, so he cannot pass on the credit, that gets reported under composition column. All other B2B transactions get reported under relating to other registered entities column. And lastly, any expenses that you have incurred from unregistered pays, that gets reported into the final column. So your entire expenditure, you have to bifurcate between, I would say broadly, three categories. Expenses on which GST has been charged, expenses which by their very nature are exempted from GST, like power and fuel salaries, and expenses which conceptually attract GST, but because the vendor is unregistered, he has not charged GST. So you bifurcate it three ways. On the first category, that is expenses on which GST is charged, you do a further bifurcation, B2B transaction on which you have claimed ITC, and transactions with composition dealers where you are not eligible for ITC. So this is going to be again a massive exercise in terms of allocation, but I personally believe it's not that big an effort, which as compared to what it is made out to be, because already you have reporting obligation under clause 27 for input tax credits. So it's just an extension of clause 27, where under clause 44, you have to report this information. Right. Now we have about 5 minutes on the clock, so I will just quickly take some of the questions that are here. Okay, Kushi is asking, can you give an overview of 269 SS, ST, and T? It's a topic by itself, but broadly what it says is 269 SS deals with receiving loan or advance, loan or deposit in excess of 20,000 rupees. It also covers advance received for sale of immobile property. So any transaction of loan or deposit, as far as tax audit is concerned, whether it is cash or non-cash, any transaction of loan or deposit in excess of 20,000 rupees should be reported under 269 SS. 269T is the mirror image. So 269T talks about payments. Payments, repayment of any loan or deposit again in excess of 20,000 rupees, cash, it may be cash, it may be non-cash, it should be reported under 269 ST. 216 ST sits in between. It talks about receipt of 2 lakh rupees or more in relation to a single transaction or in a particular day or in relation to a single event. This is typically cases of event management companies, interior decorators. They have to report it under 269 ST. Anyways, I'm going to leave you with the presentation, so the details are given on in the presentation here. So I hope that was a very high level but a quick overview of 269 ST. Query on MAT, well, not relevant to the topic that we are discussing at the moment. So because I have to go to the other questions, I will skip that. Book entries is also considered as total expenditure, yes, because ultimately that expenditure is debited to P&L, you are claiming deduction for it. So entire reporting under clause 44 or for that matter clause 34A should be aligned to the amounts debited to P&L. Okay, clients receive demand notice because income declared in 16D, but income shown under proper income as if it is interest under income from other sources. Okay, this is a classic case where, let's say, a savings bank interest reported under 16D. It's actually a case of incorrect reporting. It should not have been reported under 16D in the first place. So a better solution would be you could do either you revise the tax audit report, remove the disclosures from 16D, and then the client can put the request for reprocessing. Or second option is keep the tax audit report as it is. Client should file a rectification, include that income under the relevant clause in the other income schedule, and then put a corresponding deduction in any other amount allowable as a deduction in the return of income, so that the taxable income does not change, yet the return gets matched with the tax audit. So either of the two, based on the practical situation, you can take a call. Next is if I get an invoice as on 1st April 21 for the period of March 21, so is it prior period expense? Well, if you've got an invoice on 1st April, first of all, the point of receiving invoice is not relevant. Because it is a fee for March 21, you should ideally take a provision in March 21. If you have not done that, if you have recorded it on 1st April 21 without taking a provision for last year, then definitely it's a prior period expense. Okay, then where to report savings account interest credited to capital account does not get reported on the tax audit report. SSC has to deal with it in his personal return. I will just skim through one or two more questions if there are any. Okay, if the auditor is unable to find sufficient evidence about fraud and he skips reporting under clause 30, is he still liable or guilty under the act as we certify as true and correct? See, that's the problem with 30C, right? How do I read a client's intention? How do I know that whether the transaction is designed for tax avoidance purposes? What am I expected to do as a tax auditor here is to do my due diligence. Are there any transactions undertaken by the client which by themselves look very odd? Then yes, I have an obligation to investigate. But if I have taken reasonable care, I have done a due diligence, and thereafter, something is figured out, I don't think so as a auditor I am responsible, even though I am reporting as true and correct. At the most, at least what we do is, even without 30C coming into operation, we take a management representation from the client saying that he has made disclosure of all transactions that are material for tax audit purposes. So I think a management representation and a reasonable diligence should help your case. Right. So with this, because we are short of time, I would have been happy to take more questions. But because we are short of time, I'm commending the session back to the office bearers. Hrishikesh, if you can take charge of the session again, and thereafter, if there are any questions, I'll still be happy to take those. Thank you.
I guess there is one question from KK. If it is possible to resolve, we can definitely take it out.
Yeah. So if the SSC is individual and tax audit report is prepared for him, then where to report savings account interest? As I said, it does not get reported. Tax audit is an audit of business, not of the SSC. So the SSC has to take care of savings bank interest in his own personal tax return. So that's so I hope that clarifies the response. There are just a couple of slides I just wanted to put up. This is what I wanted to say at the end of it. We've gone through the entire tax audit provisions. It's not easy. Responsibilities are onerous. We can only do our own due diligence, but at the end of the day, the responsibilities are increasing. The government, the department are expecting more and more from us. As much diligence as we can do in completing the tax audit, it will help our collective profession. Yeah, thank you.
Thank you very much. Thanks a lot. And if anybody wants to propose a formal vote of thanks, any of the students or members, we would most likely be glad and happy. You can unmute yourself and speak out.
Thank you, sir, for this wonderful session. It was really very informative.
Yeah, your name, please.
If I may add here, I had to rush through some of the provisions because there is so much to talk on each of these provisions. So, it's more like, we have just touched certain provisions and moved further in the interest of time, but the subject by its very nature is that much vast.
Yes, there is some query from Vivo. Yes, you can watch it on Satara WICASA of ICAI YouTube channel. It is available once again. And yes, it was really pleasure, wonderful sir session आपने cover किया. And although you had to rush, but वो हमें पता नहीं चला कि आपने थोड़ा सा भगाया है. And it was very fantastically covered. And you are also great answering all the queries properly during this session. So we are really grateful, and I hope your health condition is right now better, and we pray to the Almighty to you get recovered very early, very soon.
Thank you.
Hello.
Yes.
I'm an inter student. Thank you for the session. Thank you, Chetan sir. Thank you, WIRC. This session was very useful for me because I have just got introduced to tax audit for the first time as I started in my articleship, and you explained very nicely about. And one thing I very much like was where you took questions at every stage, so that clarified what you want to say and what you don't want to say. So that's what I took from the session. Thank you.
Thank you, Kunal.
Yes. Thank you, Kunal. Anybody want more feedback? Oh. Thank you, Amul. Chetan sir, compliment for you.
Thank you, Amar.
Sir, it has been really a wonderful session. Me and other staff in the office were also over here just going through all the things, and it has really helped us quite a lot to clarify all the doubts. And you have given a new perspective to think, that is really amazing. Otherwise, it had been a routine thing, but now we are having a new perspective to think about it, and whatever queries are there now, we would try to think like the way you think, and so probably we would get solutions earlier. Thank you so much for the wonderful session.
Thank you, ma'am.
Yes, thank you, ma'am, for your wonderful deliberation and wonderful concluding remarks. And actually, it has been proved by the feedback also. We are having more 5 stars and 4 stars, 67% and 33%. So we are really grateful to all the participants for patiently hearing and attending the whole session throughout the day. And we are really regretful for some technical glitches. We will try to avoid those in futures. And sir, both, thank you very much. And if जब opportunity मिले, we will like to see you at Satara in physical session.
Look forward.
Yeah.
Thank
We
you.
would yes, ma'am, and also vice person is also there here, so definitely we would be in a great position to welcome you.
Sure, look forward.
Okay, so thank you very much, Chetan sir. Bye bye, See you later on.
Sure. Thank you.
Chetan sir, PPT.
I will immediately in the next. I know there were a certain concerns from people of not getting the presentation in time. Give me 10 minutes after the session. It's just that the attractive imagery that we put should not ideally go out in an official presentation. So I'll just remove those slides and keeping the text intact. Give me 10 minutes. I'll send it to you, Rishikesh.
Yes, sir. Sure, sir. And for the rest people, yesterday's session PPT has been already shared in the Telegram channel. So you can download it from there, watch it and use it. Thank you very much. Telegram channel की link आपको link tree की मैं link आपको chat box में भेज देता हूँ, so that you can use it out. Thank you very much. Thanks a lot.
Thank you. Rishikesh, I have mailed you the presentation. I've already sent.
Okay, great, sir.
Okay. Thank you. Bye-bye.
Thank you. Bye-bye. So guys, we are ending this broadcast, live broadcast, and you can